I still think there's a big place for it, my portfolio personally, but I think there's a big opportunity to go maneuver real estate capital and focus to a more opportunistic type environment. Right, and what Aaron was talking through as well, I think it's a big opportunity of truly finding off-market value, but looking at targeting sellers that really don't know what they have or don't have a plan to go exit that. Like if you look at buying multifamily, multifamily apartment complex, like Rob was saying yesterday, when you're in that, big boy type deal size, every single thing is brokered, meaning that you have someone who's professional who is digging into the value, what it's worth, their context to help them sell it. We feel as though in the business side of the house right now, you have an opportune time to go target people who don't have that same opportunity to go exit their companies they've built. Huge difference too in terms of the emotional side of it, which we can cover here as well after, but more so see it as a big opportunity in the market to go really focus somewhere else that I think has a lot of runway to go and a good opportunity time for it.
Good morning. My name is Chris Salerno, founder and CEO of QC Capital. As Sam introduced me yesterday, we are heavily in the car wash space. We're based out of Charlotte, North Carolina, so right there in the middle East Coast. Heavily focused in the Southeast on car washes. We used to be in the multifamily space prior to 2022 and then pivoted at the end of 2022 into the car wash sector. Like Sam said, with this type of business, it's a lot of mom and pops. We're dealing with 80 to 90% mom and pops. And then when we ask for a P&L, they don't know what it is. So we get a screenshot, of a napkin sometimes of the P&L, which is fine. That just sees a lot of opportunity there. Thankfully, they can't mimic their POS statements. So we're able to back on where we want it to be. But a lot of these mom and pops really don't realize they don't have an exit strategy. When we all buy multifamily, we go in with what's going to be our exit? Is it 3 to 5 years? These mom and pops don't have that. And for a good business, it takes around 1.5 to 2 years to prepare a true sale. You want to make sure your expenses are in line and things like that. So we're excited about the car wash industry, especially excited coming down here in Florida and in South Florida and buying more.
My name is Jason Moore. I live in Nashville, Tennessee. I have 5 children ranging from junior in college to second grade, so I'm very dependent on my investments doing well. I was a 23-year founder and operator of technology companies, software companies. Exited my last one in 2022 to private equity. Started becoming an alternative investor like you all in 2019. I may be unique in the sense that I have 0 real estate assets in the room. So mine's like alternative to the alternative, if you will. My main gig is bourbon wholesaling. So we buy bourbon around the 2 to 3 year old bourbon barrels and then sell within 2 to 3 years. So we're usually selling that 4 to 6 year window. If you know anything about bourbon, that's typically where things are bottling. We buy from the top 5 distilleries in Kentucky only. I am originally from Western Kentucky, so I'm very partial to Kentucky bourbon, which most of the world is. That's what I'm doing. I have a lot of other things to talk about. I think that's the intro. Cool. Yeah. All right.
So let's just get briefly into what you raised for and then also the why.
Yeah, so I think I covered a bit, but we view the service business space as just really opportune timing, right? You can go buy companies for 2, 3, 4x in terms of their EBITDA, and you have 2 different markets, right? You have the mom and pop, right? Think of the person buying a business that's doing a few $100,000 of EBITDA, $1 million of revenue, right? $2 million of revenue, where you have someone buying with an SBA loan. And then you have the other side of it where you have these private equity shops who need to go deploy checks of 20, 30, 40, $50 million equity checks. And those companies are, 25, they're probably $50 million plus to go in terms of top line revenue. And you have to be in between, right? Where we see the in-between value is they're still priced in a similar way to the smaller side, but they're easier to go consolidate in terms of 4, 5, 6, 7 companies that you can go package for the bigger side. So in turn, you're being paid a very large premium to go in and do that groundwork, right? Go find companies off market, go interact with sellers. So a bit different than multifamily is these people, like Aaron was highlighting too, it's been their last 10, 20, 30 years, their name on the company in terms of building it. So the process of going out and buying is a bit different, a far more emotional type sale, where people with multifamily or other real estate asset classes more so commoditized in a certain way as this is investment, they move on from it. right? Whereas this business is like, this is their blood, sweat, and tears that went into it. So in turn, we really feel if we can go connect the sellers in a meaningful way, find them off market, that there's a huge value in taking that 2, 3, 4, 5 company in terms of their multiple to an 8, 10, 12, right, in terms of the exit itself. So we view it as a lot of opportunity in terms of market, in terms of rebranding. The first company we bought the Pave out in Phoenix, Arizona, they didn't have a website until they went to go sell. So things like modern marketing can play a huge, huge role in terms of kind of taking their success, their groundwork, and really packaging it nicely for someone else.
Yeah, I think marketing is huge. A lot of these mom and pops don't know how to market. I mean, unfortunately, when COVID hit, a lot of businesses went out. The reason why is they didn't pivot to marketing or, e-commerce and things like that, or Uber Eats, if you're a restaurant. So when we see these type of businesses, we see a lot of opportunity in the marketing itself. If anyone's ever watched the movie The Founder, about Ray Kroc and McDonald's, the biggest thing that I took away from it is when he was leaving the bank, a gentleman approached him and said, "You're not in the burger business, you're in the real estate business." So with car washes, we own the underlying real estate. It gives our investors options, just in case if something does go south, we have that physical real estate where we can either sell off the business, keep the real estate, triple net lease it. So we're still real estate individuals at heart. It also brings us phenomenal depreciation and a 15-year depreciation schedule. But what we're finding is it is a lot of feelings with these mom and pops. They do not know how to market. They haven't prepared for an exit. They don't even know that process. Some of them have 1, 2, or 3 car washes where we're able to just go in, buy them in bulk, and then start scaling in these cities. And we really, because we're buying locations, it's all about the data, demographic on these sites before we actually dive into it. And again, these mom and pops just don't understand it from a business perspective.
Bourbon barrels don't have a whole lot of emotion. They're getting smaller all the time. It evaporates as it goes. I think I've heard many of you talking about how, in the past few years, a lot of people try to become real estate investors, and many of your deals are coming up because those operators, pencil deals incorrectly, pencil deals too myopically. And I think that's going to be happening in the bourbon market as well. I started investing in bourbon in 2019. The next 4.5 years were incredible returns. Those returns are not normal, and they're not, projected out. So I think a lot of people became wholesale investors. There's quite a process. You have to have your federal basic liquor license and things like that. But a lot of people got into business, and I think we're expecting the 42 to 48% IRR to continue, and that's just not sustainable. It's not real. We project anywhere from 22 to 32. 32 is pretty high, so really 22 to 28 conservatively. And I think we're going to see a lot of buyers from last year wanting to dump barrels at the 3-year mark at 2-year prices, just because they it's not living up to what they thought it was going to, and they just need to get out. So we're looking at that in 2025 as a strategy. I also work for a venture capital fund that was my main backer with the software company, so I see a lot of deals like that. I'm an LP in some seed capital funds, some venture capital funds. I do direct hard money lending, but not with real estate, of course, because why would I change? And then I also invest in a coffee fund. So I have an equity play in a coffee company like Bridging. It's called Bridging Tables. So bridging the global coffee trade, but also we do the back end lending as those coffee beans go from cherries to grain to roasted to on the shelf throughout the U.S. So I just wanted to throw that stuff out just in case you have questions around anything like that as well. So, but my main gig is bourbon, so that's why I like to talk about the most.
So out of curiosity, what are the structures and splits you give to your investors as how you pitch them and things of that nature?
So part of what our big thesis was you can go take real estate capital for people on the retail side of the house, the fund manager side of the house, may have a lot of current exposure in their portfolio to real estate. I know for myself, I've invested in 65 or so LP deals, most in the real estate space. In 2022, I had 12 deals sell. Between 2023 and 2024, I think I had 1 maybe return of capital, right? So when you look at liquidity, you've got a lot of shares outstanding in your portfolio that are very heavily weighted towards real estate. Then there's a big appetite for folks who want to go make that pivot from, maybe not all in, but maybe moving portions of their portfolio to alternatives of the alternatives. And so for us, we try and structure in a really similar way. where you can go stack up the pave, for example, and it looks very similar, different numbers, but very similar to a real estate deal in structure in terms of hold time, measurements, pref, and it's still behind it. So for us, we have 3 different economic classes shares between a 12 and 15% pref, then 50-50 to 70-30 in favor of the LP, depending on their check size. So you're making it very, very simple, single hurdle TBD if we try and do that again, because I think there's opportunity to go stretch the returns as a sponsor when looking at the different hurdles discussed based on return metrics. So right now we've tried to oversimplify. I think in the future we may look to be a bit more aggressive in structure as certain metrics to incentivize performance both ways.
For us, we have 2 different type of classes. We have a class, or 3 essentially, with our fund-to-fund managers, and we have some individuals in here that have partnered with us on the car wash sector. We offer 10 to 12% annual returns with monthly distributions. Starts within 90 days of essentially receiving your investment and or the acquisition closing, depending on where you're at in that process or where we're at in that process with the fund. When it comes to our fund-to-funds, we offer them 15%. So essentially every $1 million a fund manager brings, they get $30,000 as profit on an annual basis. So our fund manager is getting paid $30,000 every single year just for bringing $1 million. And we use TriVest for our fund to funds approach. The great thing about the car wash sector is that it has a 15-year appreciation schedule. So the Trump administration last go around put in with the gas stations and car washes at a 15-year depreciation schedule. You can still take bonus and accelerated depreciation. So our first fund, essentially, we told our investors it's around 60 to 70%, but on paper, it was 83% on 2024. So very large tax benefits because we also own the real estate and also very high returns. The biggest thing about the car wash sector is that we own the underlying real estate, so it operates as a business with high cash flow, but we still have the real estate, the building, and things like that, which is very beneficial overall, and it gives us that safety net.
So let's talk about the negatives. We have no cash distributions throughout the process. You're holding the full 24 to 30 months to get that. So that's one downside versus real estate, I think. We have 2 classes. We have the standard proof, which is 6% annual preference paid at the end with a 55% split to the investors and 45% to the fund. That's a $100,000 minimum investment. And then we have cash strength, which is $500,000 minimum investment. It's an 8% annual preference, simple interest, with a 75% on the to the investors. The cash strength is basically the same product that we offer to fund managers. And the way the mechanics work is their LPs get pretty much exactly what our direct standard proof investors get. And then they're making that spread between those 2, between the preference and the ongoing split.
So what immediately jumps to me, because you're all in the alternate space here, is how do you win investors to put, cash, their hard-earned money in your deals as opposed to the stock market, a traditional deal, or something that they can frankly do themselves?
I think a lot of it ties to the education, right? The more foreign something to someone, the more education you have to do to help them understand it, right? People don't invest in things they can understand. So part of what we did on our end was make it look as similar as possible, return profile, deal pitch deck, right, thesis behind it, to a real estate project, right? People are really used to seeing, real estate deals for experienced investors in that sense. So for us, we try and make it really simple, right, in terms of how they view it, very simple business plan, very clear in terms of, who we bring in for expertise. I think that's a big thing as well. That's what Aaron was talking about here too, is that we want to find operators in that space that have very specific expertise in that sector that we're in. For example, on our end, I have myself and 2 partners in the PAVE. None of us have paving experience, right? But in turn, we found a CEO who has years of experience in the industry. We found an advisor who has scaled the company from 0 to $45 million EBITDA per year, right, through both organic and acquisition. So in turn, you're filling out that roster of people that you have that give credibility to what you're doing. So part of it for us is really telling that story, highlighting the market opportunity for what's going on. And part of it too is you're explaining, yes, you have significant upside versus other types of projects and potentially the stock market, but also explaining how you're covering each area of risk you have as well. what you're going to mitigate it, kind of what your backup plan and contingency plan is here as well.
For us, I think we got into the car wash sector at a great time. I'm sure with everyone who does multifamily, who pitch multifamily deals, you may offer a 7 or 8 pref, but your cash flow's 3%. You know, in year one, it may creep up in year 2 to 4 or 5%. So essentially, you're only paying that 3 or 4% in year one to your investors because you can't hit the full pref unless you're raising for it. So what we got, back in early 2023 is a lot of kickback. Well, I can just put my capital in a money market account and get 5%, and I have access to it. And I said, yeah, I really don't blame you. So I after analyzing a lot of asset classes, my biggest thing to bring to our investors is wood is something that we can just beat the market with. And that's essentially the car wash sector where we're offering 10, 12, and 15% type of returns. We also offer the tax benefits. So you can't come and say, well, I'll put my capital in money market or a CD and get 4 or 5%. Well, we offer 10 to 12%. So we're doubling that essentially. Plus we have the safety net of the underlying real estate. So we found that. And thankfully the time that we got into it and talking on experience, businesses are very difficult to run. You need to have the right team. I mean, let's look at Elon Musk. He has multiple different businesses, but he knows how to put the right players in the right positions. For us, a lot of your big players, we have 2 large publicly traded companies, Driven Brands and Mister. They're publicly traded on the stock market. They were laying off big time because they overbought in 2022 and 2021. So they overbought, they were laying off. So essentially, all of 2023, I toured the whole East Coast, Midwest, visiting chemical manufacturers, manufacturers of our equipment, building manufacturers, to get a really good understanding on how these car washes operate. And a lot of people were laying off. So it gave me the ability to cherry pick our COO. His name's Keith Lawrence, out in Phoenix. He'll be coming to Charlotte, has over 12 years of car wash experience, built 2 of the largest car wash companies in the United States, the top 5, and then sold each of those off to private equity. And so I was able to bring him on board. We had already the systems, the processes to be our COO of all of our car washes. And then from there, he is now bringing his team from the other car wash companies on board to us. So it really helps, I think finding that right opportunity in that right time and just taking action on it too with the right people in place.
Surprisingly, I think more than 50% of our investors are kind of first time investing in an alternative asset class. So talking about the stock market or whatever it may be, it can be a little tough. There's a little cachet to bourbon. Bourbon's cool, so they're interested in talking about it. One of the best ways is to actually illustrate some of the barrels. I failed miserably by not talking to Sam yesterday and sponsoring the happy hour last night. Could have been 4 to 6 bottles at very, very little cost and let you see exactly what we're buying. Like the Bardstown Bourbon Company, if you see it on the shelf, Origin Series Black Label, that's bottled at 6 years, and that's 65% of our barrels. We're buying that at 2 years and then selling it in that 4 to 6 range. So it's really, really good product. So typically if you allow people to sample a product and say, okay, that's actually a brand I've seen on the shelf, it gives it some cachet too. And then the returns, as Chris was just saying, if you're converting them from the stock market for the very first time, it can be a little tough, but if they have enough, they can do $100,000 over a larger portfolio to get out of that 4.5%, 5%, grind and throw on. And, the stock market is volatile. If they're aging into an area that they can't take another 30 or 40% downturn, whether it be election results or all of the SEC scrutinization over tech companies right now, it's a little bit safe. Generally, bourbon, the longer it stays in a barrel, the more expensive it is. It's a fairly risk mitigated platform. I lived in the tech startup world. Zero was always in play, to literally the day before we sold the company for 9 figures. We could have gone bankrupt, in 60 days. Aaron was crushing it and he couldn't make payroll in 3 weeks. That was always the case. Bourbon's not like that. The double insured, I think the double insurance piece is something we also convince people of. So we're under the distillery's insurance policy, but that only insures up to our purchase price. And then we have a secondary policy with Lloyd's in London that we get a third-party physical audit of every barrel we own twice a year. So we get a mark-to-time value there. And our secondary insurance policy will make our investors whole to some of our gains at that time.
So you can't get an investor without educating people, right? Having them know what's going on. So I'm curious to know how you educate and kind of nurture through the process to get them, to say yes.
Schwab, in fact, does not allow your self-directed IRA. You can self-direct it into their products. So you do have to kind of get out of that system. I think that's but probably 70% of our investors are using qualified money. So even educating them on what, alternative IRA, systems to use. We have a few that we really, really like to work with. We don't make, direct recommendations for reasons, but we do have a few that we guide people to and have good relationships with. So that's actually a big piece of, not understanding that your quote unquote self-directed IRA is not truly self-directed until you get out of the system. And that can be, really scary for somebody doing it the first time.
One thing I have a saying in our organization is I have a son, he's 4.5 years old, he'll be 5 in December, but it feels like he's really going on 25. I like to say I'm the COO, he's the CEO of the company, but he does sit in our meetings. And the biggest thing amongst everyone in our organization is I say you have to explain it to Cruz. Cruz is my son. So you have to have it explained to a 5-year-old. So if you're going to pitch a pitch deck, have it explained to a 5-year-old. And the reason why is because we all want it simple. We don't want it complicated. And when we start to have things complicated, it starts to really question, and it takes a long period of time to build that trust. If it's just simple, we have found that it's a lot easier to pitch investors, talk to investors about it. So that's my famous saying throughout our companies. You have to explain it to Cruz. No matter what you do with our marketing ads that we do, even on each site, it has to be explained at a 5-year-old level so people understand it. It needs to be simple. So the simpler, the better.
So for most people can rationalize their decision or can buy with emotion and rationalize that decision with data. So on our end, it's more so telling the story of why, right? Highlighting the opportunity in the market, highlighting why we're targeting certain areas, certain types of companies, why we're targeting, this sector itself, the business plan behind it, who we're bringing involved, and then the data to go validate those assumptions, right? In terms of highlighting that we can go acquire companies in a certain range and showing other firms that have successfully sold or exited portfolios that look similar and the range they're getting for them as well, right? So it's, helping people understand the vision behind what you're doing, the market opportunity itself, and then showing all the data to help go back those decisions as well, and showing where you're leaving that buffer room, right? I think people, when they look at investments, they want to understand, if all these things go wrong, where do I stand? And if those things don't go wrong, what opportunity do I have if they go right? I think for us, it's the education, right? It's helping them understand who's involved, what they're doing, right? Back on that experience we have, and then showing the market opportunity itself with previous transactions or companies or different things that look really similar in that sense too.
Yes. When convincing people to move over to something like this, we're able to get asset-backed lending from traditional banks. It's at prime plus 0.5%, so that people that are more conservative in nature, when they hear that and they can see that we can get loans for this at a fairly low rate overall, I think that gives them a bit of confidence. So every time the rates are going down, we lever up about 28%. So my partner and I kind of decided to lever more than 30%, which is fairly low, low rate, especially compared to real estate. It was just to juice the returns. It was actually a challenge that Dylan gave me after our first or second call. He was like, "Why are you not, using debt to produce your investment returns?" And my answer was, "I don't know." So we did. We faced Dylan.
So last question here, what are some of the pain points in your businesses that you have to kind of push through?
Oof. So I think one just ties back to the sellers you're working with, right? Like, this is someone's business they built for decades. And in turn, you think you've got a deal done and you may not have a deal done at all. And that may take a year and a half to come back to you as well, right? So they're not viewing it as much as dollar and cents. They're viewing it as, I'm selling my life's work. What am I going to go do now? And some people aren't ready for that always. They don't have that plan thought out. I think that's a big one. And then just also making sure, like, when you're taking over a company, you think you know everything going into it. There's a lot of things that you go find that you did not plan for. So having that buffer room in place, having people in place that can go fix those areas are huge, huge, huge things. Like, it's not as if you're buying a property from an institutional type seller that has a, big four firm doing their accounting or their in-house team that's doing it. Like, you've got spreadsheets, you've got some guy's car, his wife's car that run the business for the last decade, all these earnings, different places you have to go try and find and uncover. But again, that's also where the opportunity lies as well. And part of the reason you're being compensated so heavily for doing that legwork. So all those problems are areas of opportunity that if you manage them the right way, it can be huge areas of upside for you.
Yeah, there's definitely a lot of pinpoints. What we have found is over the past year and a half in the car wash sector, and I'm sure this is in a lot of other asset classes as well, is that sellers still have expectations of 2022 and 2021. And unfortunately, we have to come to a realization with them to let them know that those expectations are not reality given the current market environment. And I think the biggest thing is being disciplined. Having that ability to walk away from a deal, even though, you like it, it may be close, but it's just not right there. And with our deals, they are full recourse. We're also bringing investors capital, so we are okay with walking away from a deal. So I think really being disciplined, and then again, making sure you have the right team in place. No matter what business is, even if you have a multifamily asset, you want to make sure you have the right property manager, the right leasing agent, the right head of maintenance up on your sites. It all comes down to the people. So if you find the right people and you put them in the right position, they're going to treat your customers right. You're going to then be able to grow a nice flourishing business.
Bourbon barrels don't give a whole lot of pushback on things, so it's the operations is pretty low lift. That's actually one of the advantages, I think, even for fund managers. There's not a ton of communication. There's not, we don't have that cash flow for your LPs, but there's also not a lot of lift between the attracting the investors and the selling. So I would say that those are the two biggest things, even for our operations, is attracting investors. And then we continuously build relationships with new brands throughout Kentucky that would be buyers, that 2 to 3 year mark. So yeah, the operations are pretty low lift, in between those times.
Open it for questions if anyone has any.
Yeah, what's your favorite bourbon?
All right, what's my favorite bourbon?
Go-to.
Usually the one in my hand.
Yeah, the go-to that you're going to when you're going to.
The go-to is actually the one that we own 65% of, and it was that before I ever bought a barrel of it. It's Bardstown Bourbon Company. They have a lot of different series, but it's the Origin series, and it's the black label. That's their 20% wheated. If you get the Origin series white label, it has a rye 36. It's still bourbon. One of the rules is that the mash bill must be 51% corn to be bourbon. So 36% rye bourbon is a high rye, but bourbon, not rye whiskey. So if you like ryes, that one is a really good one. If you like wheated bourbons, that black label is the go-to.
All right. What did you say the life cycle was for? What's your projected life cycle for a barrel of bourbon?
As far as how long we hold them?
Yeah, from inception to.
Yeah, so we're typically buying barrels that are already 2 to 3 years old. They stay at the distillery. I didn't mention that. So they stay at the distillery, and then we pay a per barrel per month fee for them to rickhouse it, manage it just like their own. And then we typically hold for 2 to 3 years. Usually it's less than 30 months in total. We are closing up the round right now for the 2024 cohort. All of our barrels have been purchased for that. And I think the youngest barrel we own in that cohort is 2 years and 10 months old today. So, it'll be a year and a couple of months away from being in that 4-year the start of our sell window. But we could hold it for another year or so to get higher prices.
Yeah.
Underwriting these deals is unique, right? Every business is a little different. How do you guys approach the concept of modeling in a sophisticated enough way to give confidence to buy without getting too crazy bogged down where every deal looks like it'll fail in that situation?
Yeah, the underwriting piece is a lot. Like, the model is not as simple, especially with looking at it on our end. We model at the company level, and it all feeds into a fund level model as well. So for us, we're modeling putting together between 4 and 7 companies in this fund itself. So each individual company then feeds into the fund. But what we did at first was we took the first company we closed, the 5 or 6 part companies we have as well in terms of different timelines of targets, put it all into the same model in terms of our assumptions, right? So we actually took all of their actual data from companies we were targeting. So we made it a lot more simple versus having a lot of assumptions. So we used all their actual data. We gonna run these companies as is. Can we still make it happen? The biggest lever I think that we pull on our end. So if you look at a $10 million plus EBITDA portfolio of what we're doing, that regularly trades between 10 and 12x. What we've done to be extremely conservative, almost conservative to a fault, is we model the exit at 4.5. We're buying companies between 3 and 5x and modeling at 4.5 at exit. That's the equivalent of real estate of buying a property at a 5 cap and say you're selling it at 10, which just no deal would pencil that way. So on our end, we have a few key assumption levers, right? 1 being the exit multiple, 2 being the growth, and 3 being the expenses. We actually model our expenses to outpace our growth on a given year as well. I think a big thing too to think about is that there are way more levers to go pull when looking at things you can go do to make the business more successful, right? Say in real estate, you can go, change the signing, do all the extra CapEx, add a few amenities, put in washer dryers, gut the kitchen, but you have a limit in terms of what that area will pay based on the market itself for rent. Like if that market supports $1,200 of rent, even if you're the nicest one, occupancy may be higher. People may go prefer to live at your complex versus someone else's, but the market itself will only support so much. We feel there's an opportunity in terms of different levers you can go pull. We try and keep it really simple in terms of the assumptions we have until we get into the full quality of earnings and kind of going from there.
For us, we built out a full model. I think Dylan's seen our model. He'll be partnering with us on our second fund. And we built out a very full, detailed model. We want to make sure that when we acquire these type of assets, we use software called like Placer.ai, which tracks all of our cell phone data in this room, by the way. So I'm able to see where other people are going. I'm able to see the bulk of our traffic. Are they leaving our car wash to go to Chick-fil-A, to go to Walmart, to go to Starbucks, to go to home, to go to work? And so we're able to track that data. And we look at all of that. Placer also provides where are car washes going to be developed, possibly based off of data, and also where are they already permitting in a 3 to 5 mile radius, whatever we set. And we look at all of that before we even submit an LOI or open up discussions, with talking on pricing and everything. The great thing is that with car washes, there's a POS. So with that POS, you can't really manipulate it. So no matter how messed up their expenses are or their P&L when they give it to us, all we really can ask for at the end of the day, if that scenario happens, is send us your POS report. We're able to back into our own type of expenses because you can't really manipulate the POS, and it's going to tell us their actual gross revenue. And a lot of these companies too, you may want a forensic CPA to make sure that you analyze their financials, get their tax returns. You want to see that capital actually hitting a banking institution, so that they've actually brought that in revenue before you go ahead and acquire a business, because a lot can happen during the due diligence and then also upon acquisition. With us too, we either will close it down right away and do a full rebranding, or we'll do a slow rebranding over 60 to 90 days, just so that the customers start to see the changes, and then from there we can justify a price increase. But like what Sam said, in the multifamily space or retail office space, you really can't really push the pricing high. So you're capped out at your gross revenue essentially time over time. Whereas with businesses, you can always fuel marketing to generate more customers, to generate more revenue, and pull different levers.
So the overly complicated version would be, it matters what it is on the shelf, right? And we play in the premium space, which in liquor terms, that's $35 to $65 per bottle. So it has to math out from there, but that really is too complicated than what we do, because you have so many, the 3-tier system of liquor, so there are a lot of taxes throughout the process. But it just comes down to kind of understanding the market of what the sell price is between that 4 and 6 years, how long we need to hold it. And that gives us our buy price, our buy price window. like this last buy, we weren't gonna spend more than $19.50 a barrel, over the 2024 cohort. We ended up, there was an opportunistic buy from a bad operator, so we ended up getting about a third of that at $16.50 a barrel, so that's a massive, good purchase, and I think across this cohort, we're at $17.87. So we're maxed out at $19.50, which still would have penciled. But I think our average price for this year was $17.87. So the model can be overly complicated all the way to the shelf price, but really, you can cut some of those amounts.
Let's do one more, yeah. All right, fair. Oh, Tony.
I'll just throw some out. So when you're looking at getting into, I know car wash, you said you were looking at different asset classes, but what was your, I guess, process to pick that niche? I mean, did you look at a lot of different areas? I mean, bourbon, let's think about. I've never thought about it. How did you look at a bunch of different classes before you picked that, and then what made you make your decision on that class?
Yeah, so we looked at most things you can go think of. Everything from tech to all different areas of the service space, and similar to what Aaron was saying earlier as well, is that certain parts of the service industry space we found were heating up, right? Like you look at HVAC, for example, when Grant Cardone puts out a training program on it, the multiples go inflate pretty quickly. And in turn, the buying opportunity becomes less and less, the more people targeting that same asset class to go buy. So we felt paving was very insulated in the sense that those two groups of buyers, right? The very mom and pop, the very institutional side of looking at it, we didn't see a huge level of competition in the middle. So we felt it was something that was long track record in terms of ownership, performance-wise, but also the market opportunity itself just made a lot of sense for us.
Yeah, for us and myself personally, we sold off multifamily assets, really half of what we owned in 2022. And I know I said this a lot last night too, is that we were getting crazy rent bumps in the Carolina market. And then I went back to our team and I was like, this is not sustainable. Like, we're not going to be able to put paint and carpet and charge $250, for rent increases with this particular asset. So I said, let's sell off. And that's when I had that eye-opening experience of, okay, there's going to be a shift coming because that's just not sustainable. So we looked at all different type of asset classes, data centers, industrial, RV parks, you name it. I wanted an asset class that was still real estate backed because we're real estate at heart. We have two options if worst case scenario happens. We would sell the business, keep the real estate, sell the real estate, or keep the business. So it gives us options. So I wanted to make sure our investors had that. And then the tax benefits for us too. So that's why we didn't go straight to one business without real estate or anything like that. We wanted the benefit of a business cash flow with real estate back so we can get the tax benefits. But it took us about 6 months to really, fine tune what asset class, and then we landed on the car wash sector because 80 to 90% mom and pop. Your big Wall Street firms are now just realizing it. We also have that reoccurring revenue. So with our sites, there's anywhere from 1,000 to 5,000 members, and on the first of every month, their credit card's being dinged either 20, 30, or 40, in some cases $45 per month. And so we have that recurring revenue, and with sites like in Florida with 2,500 members, you're talking 150 to 160,000 the first of every month, and our average membership is 14 months. So over 12 years, that's how long our members are part of our sites. So that's a huge reason is that reoccurring, and that's why we picked it too.
I dabble in a lot of stuff, and I've gone further into bourbon. I think one of the things is, it seems like a massive market, everybody knows bourbon, but it's way too small for Wall Street to play. So it's really, really insulated. There was a New York fund that put a bourbon fund together to do what we do about a year ago, 9 months ago, and they shut it down in 3 months because when they were coming in, one, it's kind of a good old boys network in Kentucky, so it was a New York fund coming in, and it just was kind of rejected. They couldn't really deploy the capital that they wanted, so they actually shut the fund down. I think it was a fairly small fund to do with $300 million. But it just doesn't work. It's a little insulated there, and it's just too small for Goldman or Jamie Dimon to come in and
I think it's a big thing too, is what we saw in our space. We're running 4 sites right now from a publicly traded company in Rockland, in Charlotte, North Carolina too. Driven Brands, their annual revenues like $3 billion. A lot of these private equity companies are getting into HVAC, plumbing, electrical companies, and they're going to come in with a lot of capital, and they're going to try to limit their expenses. And in a lot of cases, what we've seen, they've overpaid, they've over leveraged in the car wash sector, and now they have to sell off because their shareholders, their big shareholders, are upset with them. And so it gives us buying opportunities because they're not putting the right people in place. So when it comes to the business, you have to make sure you have the right people in place for growth.
Cool. Thanks everyone. Give us 2 seconds to get switched over to Eden from the family offices.